A lot of times, casual and beginner investors look at hedge fund managers like they're gods. Well, they're not. Yes, many of them have access to great modeling software, teams of analysts, and bottomless piles of cash. But ultimately, they have to boot their computer every morning and take on the daunting task of deciding how to allocate their money to get a return. Just like retail investors. Warren Buffett has challenged hedge funds many times to beat the market index over a stretch of time, and guess what? They've always failed. Modern-day common wisdom, therefore, especially for retail investors, is to put the majority of your money into index funds. They're low-cost and have a long history of beating money managers of all sorts. But not all of us are satisfied with that. Some people, ironically, like Warren Buffett himself, would rather choose their own stocks and try to beat the market. While this is not investing advice, it's common knowledge that it's much easier to beat the market when you're investing small amounts of money. Let's say under a few million. As the pool of money you're playing with gets larger, it becomes harder and harder to achieve it. So like most of us, you're dealing with smaller sums of cash. It's very possible to beat the returns of most hedge funds. Once again, this is not investing advice. So today, we're going to be looking at some of the ways you can start investing and potentially reap massive rewards. Welcome back to Coach Stack, your secret weapon for improving yourself through business, investing, and personal growth. Be sure to hit that subscribe button and notification bell so you don't miss out on our next videos. Alright, let's get started. 1. Read financial reports. One of the most essential aspects of investing in stocks is learning how to read financial reports. That might sound like a daunting task, but it really isn't. Let's say you own stock in Apple. Every quarter they release a report that includes information about how much money they're making and what they're spending. These data points help you see where your money is going and also whether the company is being managed well. If it is, great. If it isn't, it might be time for a portfolio restructuring. The key financials you want to analyze for good business health are the profit and loss sheet and the balance sheet. All of this information is made publicly available and can be found with a quick Google search. Hopefully, we'll release a future Coach Stack video on analyzing financials. 2. Identify undervalued companies. Investing in undervalued stocks is one way hedge fund managers make their money. Finding them might sound like a lot of work, but it really isn't. One of the most effective ways is to calculate a company's price-to-earnings, or PE, ratio. You can calculate this by dividing the share price by the earnings per share. Share price should be pretty obvious, but it's possible you haven't heard of EPS before. It comes in two varieties: trailing 12-month TTM and company guidance. TTM is essentially a summary of a company's performance based on the last 12 months. Company guidance is a company's best guess as to what its performance will look like in the future. Either type of EPS can be used to calculate a PE ratio. To illustrate the formula in action, let's make some numbers up for, Coach Stack. Imagine that Coach Stack has a current share price of $100 and has published a TTM EPS of $11 for the past year. If we plug these numbers into our formula, we get 100 over 11. That's a PE ratio of 9.09. Generally, a lower PE ratio means a stock is more likely to be undervalued. But it's impossible to make that claim in isolation. You'll need to compare your number with other stocks in the industry or to a benchmark like the S&P 500. In addition, it's worth noting that companies are changing and metrics like the PE ratio might not be 100% reliable anymore. Tesla, for example, has a TTM PE ratio of around 359, which would seem to be massively overvalued. However, with modern fast-growth companies prioritizing R&D, production development, and marketing over profitability, it's wise to take a holistic approach when analyzing companies. Don't rely on any one single metric to guide your investments. 3. Have a strategy. If someone handed you two unnamed files, one with Warren Buffett's research and the other with Ray Dalio's, it wouldn't take too long to figure out which file was which. Why? All hedge fund managers and institutional investors make their trades according to distinct strategies. For example, Warren looks for undervalued stocks that will pay off decades down the line, and Ray looks for clusters of medium-growth stocks that will equal the returns of much rarer high-growth stocks. This is one of the biggest differences between hedge fund managers and the average retail investor. Hedge funds make decisions based on a clear thesis. A lot of people take the impulsive buy approach to investing. Their strategy consists of reading a few articles, maybe Googling best stocks for 2021 or something like that, and jumping on the bandwagon. This is a great way to weaken the strength of your portfolio because it tends to lead to fewer safety nets, which come from sound due diligence. I'm not saying you need to create your own unique strategy, just that you need to have one. Value investing, growth investing, momentum investing, there are plenty to choose from. You just need to do some research to decide which is right for you, your abilities, and your risk tolerance. 4. Invest in some investing software. Whenever you see hedge fund managers and brokers in movies and TV, they're usually staring intently at a monitor decked out with fancy-looking graphs, tables, and charts. In reality, well, that isn't actually far off the truth. Computational analysis and modeling are a huge part of institutional investing. Sure, you might not have access to the multi-million-dollar tech and models that hedge funds do, but there are tons of great models that you can learn and implement for free. And you can get your hands on great trading software these days, so you can start learning those buy and sell keyboard shortcuts. In all seriousness, it will obviously take some time to learn whichever trading software you decide on, but it's a great time investment if you plan on taking investing seriously. 5. Consider the dividends. A great stable way to make money with stocks is by investing in companies that pay high dividends. An example of one of these companies is Chevron. They're currently trading around $107 per share and they offer a yield rate of 5%. That means that if you were to buy their stock today, you'd be getting paid around $5.30 a year for every share you own until either A. you sell your shares, or B. they can no longer afford to pay these generous dividends, so they stop offering them. Just because I want you to see how powerful dividends can be, imagine we buy 100 shares of Chevron for a total of $107,000 and hold them for 30 years. Assuming an average annual return of 8% per year, your Chevron shares will be worth around $1,076 after 30 years. If we sold these shares, we'd have $1,076,000. Not bad at all. But as we know, Chevron pays out dividends to the tune of 5% annually. By the 30-year mark, your investment will be paying out around $62,000 a year in dividends. That's cash you can spend, save, and reinvest without buying or selling any of your shares. In case you're still not convinced about the power of high dividend yield yet, here's a more extreme demonstration. Warren Buffett's personal portfolio earns him roughly $8,000 per minute from dividends alone. 6. Get started as soon as you can. It doesn't matter if you're 16 or 60, investing your money is always a good idea. Starting now, whenever that is, give your money the most amount of time possible to compound. Don't worry about not having the biggest bankroll or the highest returns when you start investing. There will always be somebody who makes more money than you do, whether they're your parents, one of your older siblings, or an actual Wall Street titan. When it comes down to it, being your own boss and having complete control over your finances is really nice. But just because somebody else has been doing something for longer doesn't automatically mean they're better at it. That's all for today's video about how you can start investing like a hedge fund manager. If you start implementing some of these strategies, you might just end up with a monstrous portfolio down the line. If you enjoyed the video, make sure you subscribe so you don't miss out on any future Coach Stack videos. Thanks for watching and we'll see you next time.